Bloomberg Audio Studios. Podcasts, radio, news. And Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's get to the bond market here. So we had CPI came in better than expected, yet you have yields lower by 2 basis points in the front end. Head scratcher for me, Ira Jersey, Bloomberg Intelligence, a senior U.S. interest rate strategist. So in my 1 + 1 = 2, you get inflation less of a problem. Therefore, the Fed won't have to cut. Why are my yields lower here?
Well, it's not only that the Fed won't have to cut, but that the Fed can maybe cut a little bit, right? So lower inflation and inflation below target or at their target is a necessary condition for the Federal Reserve to cut. So the fact that you only had a 0.2% month on month on inflation, not a massive surprise. Quite frankly, it wasn't a huge miss really when you look at a lot of the details, but it was also a good sign because people are worried that tariffs are going to have an effect. But remember, the tariffs only went into effect last month, so we're not going to see that on shelf prices until this month and next month. So I think the market in general, like this relatively muted reaction from the market, is something that we're going to have to look through, at least on the inflation front, for the next until we get the prints from the next couple of months.
What's the Fed looking at, Ira, these days? Is it focusing more on inflation or more on growth? Because I think a lot of folks are probably concerned that whatever inflation levels we get, it's going to kind of hurt growth more so. What do you think the Fed's looking at?
Yeah, well, this is certainly the conundrum that the Federal Reserve is going to have going forward, particularly if we get an increase in inflation and then we see a significant downshift in growth and certainly the job market, right? Remember, the growth itself is not what the Federal Reserve's mandate is. It's really the job market. So you can have slow growth or no growth with a job market that's okay, but not great, and I think that's the potential big issues that the Fed might go to. So Jay Powell last week was pretty clear in saying that, look, we're going to basically focus on whichever of the two parts of our dual mandate is farther from where we want it to be. So if inflation jumps to 5% and unemployment is still kind of 4.5% and not climbing quickly, then they're going to focus on inflation. But if inflation kind of hovers 2.5%, 3%, but it looks like we're going to have negative job prints and we're going to have 5+% unemployment rate, then the Fed will key on that and cut interest rates and maybe give up a little bit on its inflation fighting mode for at least some temporary period of time. But we're still far away from that. I mean, our view had been going into this year, and I think I mentioned it to you guys last week, is that we always thought that the market was pricing for the Fed to cut too early. Cutting in June or July, we never thought was a realistic possibility because of this, dueling economic scenarios that you just laid out, Paul. So now we're probably pricing for something a bit more realistic. Fourth quarter, only 2 cuts this year. Mm-hmm. That's kind of where we think the market's going to kind of find a steady state.
So does that mean that around 4% is the top for the 2-year?
Yeah, I think it is, unless we wind up getting some better economic data. So, we get a upside surprise on next month's employment, and we wind up having decent retail sales data, all of those things. I don't think that anything above 420 probably on the 2-year makes sense. There's no reason right now for the 2-year to be trading above the federal funds rate, right? So why would you sell off 50 basis points in the 2-year unless you really thought the Fed was going to hike, which I think is not realistic. It's much more likely that they stay steady for the next 2 years than it is that they increase rates at any time over the next 2 years. That being said, just the financial fair value right now on the 2-year note, we have at 3.8%. So maybe the market's gone just a little bit too far, being very close to 4% right now.
Ira, are international investors still buying U.S. Treasuries, or are they still mad at us?
No, they are. And in fact, if you look at the recent Treasury auctions, they have been purchasing just the same amount that they had been over the past couple of years, actually. Around 10% of the recent Treasury auctions went to foreign investors, and that's pretty much in line. Some of the investors that I've been speaking to say, well, look, it's an economic decision that we're making. If our choice is to buy our local government debt or buy Treasuries and then hedge some of our currency risk or all of our currency risk, risk, and we can still pick up yield compared to our home currency and our home bond market, then we're going to keep doing that trade. And so until that economics changes or there's real fear that the U.S. is going to default on its debt or something like that, I think private foreign investors in particular are just going to keep buying.
Hey, Ira, always good to catch up. Ira Jersey, Bloomberg Intelligence Senior U.S. Interest Rate Strategist, joining us there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Pretty solid day after a big move yesterday in the equity indices. Let's see what the professionals are doing. Sarah Ponczek joins us. First Vice President of Wealth Management at UBS Private Wealth Management. She's down there in Boca Raton, Florida. All right. If you care, 82 and mostly sunny in Boca today. I mean, if that's your gig, fine, enjoy it. I don't know. We go for the change of seasons here, which Sarah does
He's
not.
He's just jealous, Sarah. This is all that this is.
Sarah.
You're jealous. No, if I make you feel any better, we had a really bad storm yesterday. I had palm fronds all over the house. So
it happens.
So today's sunny and warm and humid, but we are starting to get some good rain.
Good for our good friends in South Florida there. Hey, Sarah, what do you tell your clients? I mean, boy, you've had a market that just a few weeks ago was down 20% from its peak. Now, just year to date, we're back to flat or slightly up here. I mean, the volatility has been amazing. What do you tell your clients these days?
It's been a whirlwind these past 6 weeks or so, however long it's been. It feels like it's been a lot longer than that, I think for all of us. But the message throughout April, which was really the month in which we saw the brunt of the volatility, was that you need to stick with your plan, and you certainly don't want to be selling out of stocks at the lows. If anything, if you were someone who had a liquidity event, if you had been sitting on cash for a long time, that was the time you wanted to start phasing into markets and start deploying your capital and taking advantage of the volatility. Because yes, Liberation Day was certainly a day I'm sure we all remember, a very volatile one at that. But the expectation was that was peak uncertainty. That was peak pessimism. And the hope was that there would be negotiations that we would see come to the forefront between the United States and other countries, particularly China, and that we would see these tariff rates come down. Now, thankfully, that is what's happened, and we've seen markets react very favorably to that. At this point in time, you, Alix, you just ran through the numbers. Really, it's as if markets have made up all of those losses. It's pretty amazing to think about, considering the S&P at a time was almost down 20% at its low, and now we're just about flat. So sure, at this point, the risk reward doesn't look quite as favorable as it looked when the market was down 10, 15, 18%. But the outlook is still pretty positive from here, especially with the expectation that, hopefully trade negotiations will continue. And, growth is slowing a bit. Inflation, is under control, as we saw this morning. So there's other reasons fundamentally to continue to think that, 12 months from now, the market's going to be higher than where we are today.
So if the calls you were getting a month ago were, what do I do? What's changing? I'm kind of freaking out. What are the calls you're getting now today?
Well, people certainly feel better. It's really interesting. Typically investors, we all know that you want to be fearful when people are greedy and greedy when people are fearful. But in actuality, people don't always act that way. It's interesting that, the calls that we were getting at the April lows when markets were down between 15 and 20% were more panicky, asking, do we need to change our strategy? What should we be doing here? Should we be selling stocks, buying bonds, buying gold? And we did make some tweaks, but certainly weren't selling stocks at those levels. It was more so talking about adding at those levels. Now people feel better. It's interesting. You would think that when markets are at the highs, people are saying, should I take chips off the table? But that's not necessarily the case. People feel better. People feel more optimistic now that we're seeing, countries come to the table and discuss and these tariff rates come down. With that said, I'm actually about to have a conversation with a client who has a big home purchase coming up over the next couple of months. that's someone, given that we've seen a rally, that you might want to consider taking chips off the table. If you have a big near-term purchase coming up and you need liquidity, you need cash, okay, you probably feel pretty great now. You're not selling with stocks down 15%. You're selling with them flat now on the year, roughly. So that if you're someone who has something like that coming up, that changes the parameters. But we typically like to say, to clients who have near-term events where they need cash on hand, or if you're someone who is retired and you're spending down your portfolio, we typically recommend that you have a liquidity buffer in your portfolio, say, for whatever that project is, or say, even 2 to 3 years of expenses, because that way, when the market does fall, and it's going to happen, it's natural, we're all going to witness many more of these in our lifetimes,
right,
most likely. That way you're not freaking out because you have the cash on hand to meet the expense needs that you need in the near term.
Sarah, thank you so much for joining us. Always appreciate getting a few minutes of your time. Sarah Ponczek, First Vice President of Wealth Management at UBS Private Wealth Management down there in Boca Raton, Florida.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, well, let's get to one of the most underperforming stocks within the market today, dragging on the Dow Jones Industrial Average. Now, I know many people don't look at it, but nonetheless, it's a pretty chunky move, so it's worth discussing, and that's UnitedHealth. Glen Losev is Bloomberg Intelligence Senior Equity Analyst, joins us now. So, suspending the 2025 outlook, naming a new CEO, what was the biggest surprise here?
So the biggest surprise was suspending the 2025 guidance, and this comes after the company lowered 2025 outlook just about 3 weeks ago when the company reported first quarter results.
So what's the problem with this business? I thought the healthcare insurance business is just rips it.
Well, it all goes in cycles, right? It is surprising that United is having these problems, basically that began in at the start of 2024. If you remember, there was a Change Healthcare attack, and after that, it just seems that United management was trying to fix things while other things fell apart and has been on the back foot. And that's probably one of the reasons that the CEO that led the company since 2021, I believe, left the company, and the chairman and the former CEO is taking the reins to sort of reposition United for, next phase of growth.
So, right. Well, where is that growth going to come from? Because there are higher than expected medical costs, right, and some reimbursement struggles. Can you walk us through what we learned about that?
Yes, basically, the company cited that the medical cost trend among new members in its Medicare portfolio is accelerating relative to the first quarter trends, which was higher than expected already. Basically, if it continues, the company can always sort of try to get more premium per member from the government as it deals with Medicare to reset the margin expectations or normalize the margins. That being said, if the medical costs continue to accelerate, and specifically with with everything that's going on in Washington, right, with the sort of funding overhang and all that, it may become a problem over the longer term. But at the same time, managed care companies can always exit underperforming markets. It just may take a little bit longer than sort of investors would like to see.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Another stock in the news, Microsoft says it's cutting 3% of its employees to reduce management layers. I'm looking at the stock here. It's pretty much unchanged on the day. It's up 6% year to date, but anytime Microsoft does anything, we want to get to the bottom of it. Anurag Rana, he does that for us. He's Bloomberg Intelligence Senior Technology Analyst. Anurag, is this just kind of annual culling of the ranks, or is this saying something different about Microsoft and maybe where it sees its future?
I think it's a little bit of both because, and the numbers 3% does not say much. But at the same time, Microsoft is not hiring at the same pace that it used to. And I think one of the areas where it is deploying AI is coding or, R&D. That's an area where we anticipate productivity to improve because of the tools we have and not anticipating headcount to grow up. Second thing, Microsoft is investing very heavily in AI right now. The CapEx is going to be extremely high, as north of $80 billion for the next 12 months. And, that they have to offset some of that pressure on gross margins with cuts on the operating expense side so that the net operating margin doesn't get impacted. So I think it's a little bit of all the above.
Was this a surprise?
Not really. I mean, 3% to me does not come as a surprise. 3% is, in an environment like right now where companies are not anticipating the real attrition rate. So on a normalized basis, if a company is seeing employee attrition between 10 to 15%, we're not seeing that right now. So the company has to do something in order to get back to the normal range of their financial planning. So it as I said, this doesn't sound too much to me, but there could be a little bit more based on, who they are trying to get rid of. If it's higher on the paychecks, then I think it has to do with protecting your margins.
Anurag, talk to us about just what the investment thesis is regarding Microsoft right now, given some of the tariff uncertainty, given some of the geopolitics uncertainty. What's the call on Microsoft these days?
For the last few years, we have been saying this is probably one of the cleanest stories in AI and software land because it doesn't get impacted with tariffs. There is some marginal secondary impact because of, if we do get into an economic slowdown. But the real benefit for them is they are hosting ChatGPT, the most favorite app of consumers right now, and they get the benefit of that. So if you have, let's say, your user base goes from 200 million users to 300 to 400, now we are close to about 500 million users. It really helps Microsoft because they are hosting that app. And as those users use ChatGPT for a longer period of time, they get to make more money. So I think that's really one of the bigger benefits where they are offsetting the risk that we are seeing that other software vendors are seeing because of the lack of headcount growth across the tech landscape.
So based on that, do we think that we're going to see other tech companies follow suit in this particular way? Like if Microsoft is a creme de la creme, as you see it, who's next?
So, Alix, when you look at it, as I said, 3% does not scare me as much. But if over the next 6 months, companies come out and say, well, I'm laying off like 7 to 10% of my workforce, that is concerning because that's concerning for two reasons. One, these companies do buy software from other companies, such as a Workday or a Salesforce, because these two companies are seeing some pressure on their seat growth because their end customers are not hiring as much. So lack of hiring is a concern, not just for the companies or the industry themselves, but for the software landscape as well, because primarily this is a seat-based, monetization model.
Anurag, before we got all enmeshed in tariffs over the last few months, we seemingly talk to you every day about the AI story. That's kind of fallen off the radar screen a little bit here for, I think, global Wall Street. Not for you guys. What is the AI story today? What's the feeling in the marketplace about AI as a growth story for tech?
Yeah, one of the things DeepSeek did for the entire space was divided the space in two different buckets. One was the AI infrastructure play, and the other one is more on the application side of it. And Microsoft, I think, guided them a little bit towards that framework because when you look at it, Microsoft is really focused on the inferencing side of it, which is hosting the applications. Things that are more on the infrastructure side, whether it's the chip building from NVIDIA or a recent IPO like CoreWeave, they have not done as well as some of the other vendors because people are wondering, why do I need to play the infrastructure game? Because it's CapEx heavy and we do not know how things are going to shape up in the next 2 to 3 years. One thing is sort of certain that even after 3 years, the number of use cases on AI is going to rise. So you want to be on the application or the inference side of things rather than the infrastructure side of things.
Right. And that's going to be a lot more profitable going forward, but it also requires something very different at the end of the day, right? You're going to have basically locations that are closer to the actual use point, right? So closer to where I am and where you are versus out in the middle of nowhere, but you have a huge heavy load. How does that change either investment or power usage, et cetera?
That's probably one of the most important questions out there right now. So somebody like a Microsoft is saying, for my training needs, I will go to those data centers that are out in the boondocks and middle of nowhere, and that could be my data center, or I could lease it from somebody like a CoreWeave. But for the application side, I'm going to create or lease smaller data centers that are well connected, where I'm going to do the inferencing or from the user point of view.
All right, Anurag Rana, thank you so much. We appreciate that. Anurag Rana covers all the technology stuff for Bloomberg Intelligence, getting the latest on Microsoft, laying off 3% of their workforce.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.